Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Pankaj, welcome to the Investor Hour. Delighted to have you as a guest. I've been meaning to talk to someone from both Kotak and Midcap, and you're like the overlap of both. And I'll tell you why. Because one of my friends who researches mutual funds told me long back that if you're looking for true blue money managers, then there are very few fund houses. There are dozens of fund houses out there. And he said one of them is Kotak. So that's the Kotak reason. And midcap, because I believe that still, even though information and media has become big, in that space, there are still, I can imagine how exciting and unknown and exciting the stories are that you find. And so I always wanted to get that side. Top down, big picture India stuff, great. We can do a lot of that. But in that part of India, which is relatively unknown. So when I spoke to your colleague and I was like, please make this happen, he said, yeah, sure. I've talked to Pankaj and get this done. So I'm so delighted we're doing this.
It's a pleasure.
You're doing this, I think today is the 10th of September on a Saturday. So thank you very much. You're doing it on a Saturday. You've got a busy schedule. So let's try and make the most of it.
Thanks, Rahul, for having me on your show. Really looking forward for the interaction today.
Wonderful. So let's kick this off. So, Pankaj, tell me a little bit about yourself. I want to go right to the beginning, right to the start. Tell me things like when you were growing up, what was the environment like? Were there any IPO forms lying around? Investment magazines lying around? Was your father an investor? Tell me about that a bit.
So Rahul, I come from Calcutta and I come from a Marwadi business family.
Wow. All trading.
Calcutta is full of that Marwadi business community. And born and brought up there. And, every day in a Marwadi family, if you're in a business environment, invariably you have talks about business either after dinner or before dinner, and the environment is such. The interesting part which came along was that the classic template in Calcutta is that if you are going to St. Xavier's College, which is the best college out there, the timings are 6 to 10 a.m. And virtually after 6 to 10 a.m., the entire day is for you. Unlike other cities where the college is for the whole day and you don't do anything. And if you look at any guy in finance world or in corporate world who is from Calcutta, you can blindly say that either he will be a CA, CS, or he will be had some experience from his family business. So 6 to 10 was college, and after that I decided to join my dad in his business and my brother in his business. And those were the formidable years of learning and seeing how a business actually works with a very, very close lens. And initial years, I always understood that P&L doesn't matter anything. And my grandfather and my father used to run Baukhata, Parta system, where, from the Baukhata you used to drive the profit and loss. Not the other way around like today where we make a profit and loss, then balance sheet and cash flows, but it was the other way around. And from a very start, from a business environment, it was told that cash is king. So always focus on cash, accounting profit doesn't matter at all. And I think those 3 years of my college, I think were great years for learning from a business environment perspective, how businesses are run. And very early in my career, my brother told me one day that there are huge bad debts in the business. It's a challenge, and and he gave me a lollipop that why don't you go and collect these bad debts. If you are able to, then a percentage of yours, we will take it out. So eager to make money and making sure that land up there. And those were the years how difficult it is to take out money from people who don't want to pay, and close net on the overall thought. And then, my life is an amalgamation of 3 M's. a Marwadi from Kolkata,
Mhm.
then went to Manchester, and then ended up with mutual funds. So
Wow.
all the three M's is so it's an amalgamation of three M's in my life, and the third M is still at work. And the first M is always be there. So it's been interesting, and then I wanted to get a very broader view of overall things, because generally when you are entering into a business, you become myopic. You become very focused on smaller set of things. But I wanted to get a larger view of life, and I went for my master's to Manchester University there. And it was 2001 when I graduated. I was the only Indian to make it to the final rounds of all the three marquee investment bankers of the world. So from start, I wanted to do something in finance because I didn't understand anything else. But unfortunately, 2001, 9/11 happened and everything got freezed. I came back to India and
Hold that thought. So let's go back to Kolkata.
yeah,
What was the business your father was engaged in?
logistics and transportation.
Okay.
So
And
and that was to deal with both the sides. On the customer sides, we had all the marquee names of the country, all the companies, and on the other side, you used to deal with the so-called uh, not so educated class truck drivers. So you had to see both the sides of the world, and that was fascinating, and how both the different worlds operate together. On the one side, you are negotiating with the companies where you have to be really, really polished.
yeah,
On the other side, when you are dealing with the truck owners and truck
rough
drivers,
and tough.
very
Yeah.
rough and tough and a different attitude altogether. So
So
I think both the sides had their own charm.
so and logistics like gives you an understanding of an economy, even if though you're not studying the economy, it tells you
Absolutely.
really what's happening in its truest form, other than cash. The
Absolutely.
goods are moving, not moving.
Not moving, and that really tests your overall planning, your accountability, because if the movement of good doesn't happen in next 2 days, 3 days, the client gets hyper because his factory is running short of materials. So it's a lot of learning in that 3 years process, and I
The Indian version of just in time
just
is
in
not
time,
computerized.
just
It
in time.
depends on
So I think
informal
those
methods.
lays the foundation that how businesses are run very, very closely. Unlike many of my counterparts who came directly into the field of equity research or fund management, I had a very close opportunity to see how businesses are run actually. And that, I think, formed a basis of looking at things that, is this business going to make money? Is this the right business to invest in? And those things followed on.
Yeah, and the other thing that you mentioned, which was so critical, and I think is very underappreciated, is that cash is king, because people can do all sorts of things with their earnings, right? Uh, and earnings by themselves are a result of all sorts of things,
Absolutely.
willing or not. But the fact that whether cash was generated or not, it's the truest form of test of a business.
Absolutely.
And I think uh, in the context, I think when ages ago, when I first got introduced to like business, and I was trying to understand how the Birla Group runs, and they said, yeah, at the end of every day, they'll tell you how much cash was generated.
Cash is making. Absolutely. Absolutely.
So that's the truest form in which
Truest form of business.
you can do the business. And I think that must have played some role in, and like you're saying, it has formed like an understanding of business that is pretty unique, which is
Absolutely.
deeply ingrained in you.
Absolutely. And, after I finished my graduation, post-graduation, 9/11, things were not looking that great.
Yeah.
Equity markets were crashing after the, tech bubble burst. Um, I came back to India, and still I want.
Did you have exposure in the tech bubble as a
uh,
family, as you individually?
So obviously, dad got stuck on both the cycles, even in tech bubble and Harshad Mehta.
Ah,
So Then
Wow.
he started saying equity market mein paisa kabhi nahi ban sakta.
Did you know what he was doing all along?
No, no,
You are
no,
oblivious
no,
of the investing.
no, absolutely. So then when I came back to India, I think I wanted to join any financial outfit, but everything was very very bad and things were not great. However, I got a 8,000 rupee job to start off with. That was a company called Global Trade Finance, which was owned by West LD of a very highly ranked investment banking at that point of time. They had a venture in India and they recommended me to this venture. Very short stint out there for almost 6-7 months. And then one of the persons whom I regard as my mentor, he one fine morning just called me up that, what are you doing these days? I said, I'm part of global trade finance, factoring and all that, but that's not my passion. That's not something I want to do. So, Bola, see, I have a vacancy for a credit analyst. My guy is leaving. He just informed me last night. I believe that you can do this job. So I said, I'd never done credit at all in my life. He said, come and meet me. I think you will be able to do it. So I joined, I met him and he said that, why don't you join from tomorrow? I said, okay, great. So I started my career on the financial side, on the fixed income side of principal asset management.
You're talking about Rajesh Jain.
Rajat Jain was the CIO.
Rajat Jain.
Rajat was the CIO and Binay Changotia,
Okay.
the guy who hired me out. And he said that let's start from the fixed income side. We started from fixed income. I was the credit analyst there analyzing things. But the room which we were in was full of equity guys and fund managers and myself. And there's a very fine line between equity research and credit research. Equity finally look at valuations and upside. The credit guy looks at whether there will be a default and money will come back. But the analysis and the journey of evaluating a company is absolutely the same. And we used to have long discussions on various sectors and companies. And that was the time when equity markets were going through its worst phase, right? 2002 and 2003, nothing visible out there. And I could see with my own eyes, the guys sitting out there virtually till 4 p.m. looking at their watch, when is the thing going to be striking 4, and they leave out. There was nothing to do. And markets were in sideways movement for a very long period of time. And I think that those were the years where you went into and looked into the research and the companies. And after 2 years, I got the opportunity to look after a small fund called monthly income plan. So monthly income plans are plans which have small equity and 60-70% debt. That fund wasn't doing well. And I said to my boss that, see, any which ways this fund isn't doing well. Why don't you just give it to me? I can bring in a lot of focus and probably I can do justice to it. They were hesitant, but finally they decided to give that fund to me. And within a year or so, that fund became the best on the top of the charts. God has been kind, and we brought a lot of focus, and the fund scaled up also significantly. And from there, it started my equity transition from a fixed income to equity side.
So a couple of pointers there. One is that when you were studying in Manchester, the markets were like booming like crazy.
Absolutely.
And I guess by the time you graduated, they collapsed. So you had a heady education for various reasons.
Absolutely.
And you got in at probably in the job market, probably the worst time.
Absolutely.
Possible. And I think, so I don't know how it was. We're equity guys, right? So I know equity was terrible. And I guess debt is a function of the same thing, right? The environment was terrible. Did SARS happen then? The China virus was 2002, 2003, early 2003?
Early 2003-4. And that was the time when, global pandemic also started hitting and all those noises were there.
That was like the bottom.
Absolutely.
So I can imagine, what you were going through, and then you joined this trade finance. But I'll tell you something about principle. So in those days, one of our group companies, that time I think we were still all one. That time we were all one company, and we used to actually research all the mutual funds in the country. And Principle was one of our favorite funds.
Absolutely, it was a darling fund house at that point of time till 2008-9.
And they were also very money management focused. right?
Absolutely. Absolutely.
They of course they're all distributing funds, but they were true blue money manager, if you will.
Managers.
And and we met Rajat many times, and
Oh, nice.
there were great discussions. We learned a lot, and I think quite a few of your funds were recommended by us, if I remember those days.
Absolutely.
But
Absolutely.
it doesn't exist anymore in its true form, right? Something happened globally, and
I think last year, I think it was taken over by Sundaram Asset Management.
yeah.
So, yeah.
Yeah. So anyway, so bringing back memories of what was happening those days. So you entered debt. So by the way, like I mentioned to you just before we were recording, you started your career as a money manager in 2002-3, which means we are having this podcast to effectively, we could actually cut a cake for your 20th anniversary as a fund manager.
Absolutely. Absolutely.
Superb, congratulations.
Thank you. Thank you, Rahul.
Wonderful.
Yeah.
Anyway, so you started off with debt, and you said within a couple of years you got exposed to equity, and that,
Yes.
if I'm not mistaken, would have overlapped with possibly what would be the biggest and sharpest bull run
Absolutely.
India
India
or
has ever
even
seen.
the world we've
Absolutely.
seen in a long time.
Absolutely. Absolutely. And
Tell
the
us a little bit
environment
about
and the entire environment was so amazing that from a complete grim scenario, you are moving to a complete bullish market. For a couple of years, nobody could accept it. And I still remember the elections when BJP lost. And Manmohan Singh and BJP lost the election, and suddenly market mood again changed, and market kind of collapsed because it was a big surprise. But I think the foundation had been laid by the previous government, and I think people used that opportunity to start increasing exposure. But one thing which was clear, that markets went into a toss saying that nothing is going to happen. Everybody was again saying that the memories were fresh of the tech bubble, and said that this government is gone, new government will come. But to everybody surprised, markets start galloping up again very, very fast. And I think then everything globally coincided. The easy liquidity, interest rate cuts were happening initially. And then you saw the biggest bull market India has ever seen. But in that bull market, you had various sharp corrections as well. In 2006, in 2005, in 2007. So every time it tested your nerves in a rising bull market, that there could be intermediate sharp corrections. And how do you behave in those corrections ultimately decided your overall outcome over the next 3-4 years.
How did you deal with that? Because you're new to equities, you're thrown into this roller coaster ride. If anything comes to mind in terms of, how did you react to it? What was a great decision you took? What was a decision that you thought now think you should have done differently?
So many things, early in my career, a couple of my mentors told me that always remember in this field that there are 100 variables which you will worry you every day. These are beyond your control. You cannot do anything about it. And, when you are young, you probably don't value such, advices. But when you go through that cycle, you become more and more matured. And the advice was that when you don't know things are not, when you know things are not under your control, there are only 3 things which are under your control. Always your temperament and your overall thought process, how you react in different situations. Second, the investee company which you are investing in, you should be very, very sure about the size of the business opportunity you are getting into and what the size of that company will be over 3 to 5 years. So do your research properly. And the third thing is that always partner with managements whom you can trust over longer periods of time. Because finally, it's not a paper ownership which you are getting into, it's a shareholding ownership you are getting into. If these 3 things which are under your control, if you can do these 3 things well over a period of time, the outcome will be quite okay. Don't worry about that. And I think those advices time and again kind of reinforce that during the corrections, I didn't lose my temperament, I didn't lose my focus, and kept on evaluating my investing companies with a closer lens. And also, again, I would like to repeat, that the basic thought process and concept that P&L doesn't matter. What matters is balance sheet and cash flows. Made sure that you don't get carried away too much at that point of time. Also, I think some of the mistakes which we obviously learn on the hindsight is that some of the infra companies which were on the limelight, some of the power companies which did extremely well, multiply 20x, 30x, made my own share of mistakes in some of those, but was quick to realize those mistakes and probably got out very early before they became the penny stocks and destroyed value. But it was a great journey at that point, and I remember owning few stocks which multiplied 30x, 40x during that 4-year period. Wow. And finally, when 2008 bubble burst, a lot of them corrected by 60, 70, 80%. So one thing which was that these are cycles. You need to construct a portfolio which can survive every cycle. It's not that you have to play one innings, you have to be on the pitch for a longer period of time. And that realization came after 2008-9 crash, that portfolio construction is even more important than stock picking. And I firmly believe that in India, stock picking is overrated, portfolio construction is underrated.
So I think what you just said, stock picking is overrated and portfolio construction is underrated, is one of our continuing themes in the investor hour.
Oh.
And we've been trying to ask people again and again, because the point is that allocation may have a larger impact on your wealth generation than any individual decision. The same thing what you're saying. And I'm so glad you mentioned it, because we're going to talk a bit about this. But I want to go back to you mentioned about the mistakes. And in hindsight, one has the chance to analyze them. And so tell me something, how do you you can't avoid a mistake completely, I guess. No matter how good you could have a failure. But how do you control the damage a bad investment can have? How do you, that's one part of the question. The other part of the question is, once you know that your analysis was wrong or off the mark or something is changed, then how does your sell decision-making process work?
So very interesting one, Rahul. I think we are all evolving in this art of selling. I think art of buying is easy, but art of selling is always difficult. But a few things which have helped me get early, so-called alarm fears and alerts that probably this company and the thesis is not working, is one, through the cash flow. And I'll give you small examples. So we invested in an EPC company, a road construction company, and it was very promising at the time we invested in. But after maybe a year or so, the company was not giving us good vibes, in the sense from our overall ecosystem, when we were hearing things, we were not getting positive vibes. The company kept on reporting strong P&L accounting earnings. But when we looked at the balance sheet and the cash flows, it was clearly showing deterioration. We sent our team, and I also went to many of their sites where the construction was going on. And we figured out that the salaries are getting delayed by a couple of months. Okay, that was the alarm bell.
Red flag.
And that set us going that things are not right. Yeah, red flag. And then we went into detail again. And we saw that there's something extremely wrong. We didn't get the comfort and the answers from the management, and nothing doing. We sold off the entire positions. We were lucky that there was somebody who was buying a large fund house who was buying it. And we said that it's okay. We'll exit the entire position. Rahul, maybe for a year or two, it rallied. But today, when we look at, it's worth nothing. The stock is a penny stock now. And maybe we sold 10-15% lower than an acquisition price, but it's fine, because on the hindsight, we avoided the 80-90% damage or the permanent erosion of capital which could have happened in that stock. Yeah. So that one, and probably a couple of real estate companies, in 2006 to 8 period, the mistake was that you diverted from your philosophy of cash flows and went into the land bank game. which was happening at that point, and you started valuing land banks and the NAV and all that, and made couple of mistakes there as well, but was early to recognize that finally this is going to burst because this is not going to last. Finally, the land banks converting into cash flows can take years, or it may not happen also. And I think that helped us immensely on those. But obviously, investing can't be 10 out of 10 correct. Even if you can get 6 or 7 calls right, I think the outcome of the portfolio could be quite okay.
Yeah, and I like the examples you're giving, because uh, it's only human sometimes to stray a little bit from the principles that you've set for yourself. But it's important to come back to it, because in the long run, I think what will happen is you yourself, most importantly, and the people who follow you and give you money would assess you on whether you actually stuck to what you promised to do.
Absolutely.
And I think that in itself is a measure of success or failure. The result is the end. The result will come automatically.
Absolutely.
People chose to write that journey of cash flow with you.
Absolutely.
And they're following that. And I think people understand. I think everyone got carried away. I went and bought an apartment, a small apartment in Pune in 2011-12.
Oh my God.
So thankfully it was very small. So, but yeah, I think all of us make mistakes and learn from it. But the important thing is to, not repeat it. I think that's
absolutely. Absolutely.
Yeah. The other thing, you used the word vibes, right? And this is the first time this word has come up in our Investor Hour series. But when I talk to very experienced investors, they talk a lot about gut. They talk a lot about feel, right? Now they are dealing with their own money. So they are not afraid of, I feel this is the right thing to do. But you're a professional, right? You've got to back up your decisions. But there is an element of discretion involved. Can you talk a little bit about that? On where does it come from? How do you develop it? How can you hone it to your advantage?
Yeah. So I think in India, I have realized over the last 2 decades that the most important thing in evaluating or investing in India is evaluation of managements. I think time and again, it's been proved that a great management, even with a mediocre business, can do wonders. And a bad management with a great business can destroy value. And it's been time and again proved that. And I think leadership makes all the difference. We have seen companies after companies where if leadership is strong, management is strong, I think the difference is made in terms of overall value creation. It's a subjective term, but let me take you through how we can bring some art and science to it. And I think if we can get the management evaluation right, and I still remember Ramdevji's first comment when I met him once, very, very long time, maybe 17, 18 years back, because our office and his office was just first floor and second floor.
You're referring to Ramdev Agrawal of Moti.
Ramdev Agrawal. And he clearly said that business is multiplicative of management. If management is zero, the business will automatically be zero. Okay. And that actually struck to my mind for a long time. But how over a period of time we have kind of brought some art and science to the management evaluation. It's a subjective one. So first thing, Rahul, which we do is that I'm blessed that, and the team is blessed that we have a great network of CA. And this network of CAs in every city is the first talking point when we are doing a research on any company, right? We call up those guys and ask, because if an influential CA is there, he will know the in and out of that guy. And we personally believe that if the promoter is leveraged in his personal capacity, company can't be spared beyond a point of time. Getting a lot of insights on his lifestyle, about his background, about his family, and coming from again a Marwadi business family, there's something called kacha pakka. And that sense which you get, that whether the integrity is right or not, what the ecosystem is saying, is the first point of talking checkpoints for all of us in the team. The second thing, we have brought down 5-6 indicators, because our belief is that history provides a lot of insights into the management evaluation. And there's a quote which is very famous within our team, that tigers don't change their stripes. So for a very short period, the promoter, if will try to show his character and intentions are right. But if his past has not been great, trust me, over a period of time, it will show up again.
I 100% agree with that.
So where do we, kind of evaluate managements? First is trust, and let me take you to a point that today, if you take a poll and you say that who is the most trusted group in the country, unanimously, Tatas will emerge as number one. And it is not because they have developed trust over 1 year, 2 year, 5 year. They have developed trust over longer periods of time.
Yeah.
And I still remember Dorabji's Tata's story that Tata Steel wouldn't have existed today. In 1924, he mortgaged his wife, Lady Meherbai's jewelry to pay the salary of Tata Steel. So trust is extremely important, and that's shown that TCS only had 4 CEOs till date in the last 50 years, whereas some of the other companies have number of CEOs in the same industry.
Yeah.
The second is, I think.
Can I just add one point on the trust?
Yes.
So Equitymaster actually does a corporate trust poll every year.
Wow.
And you are so right, because Tata's take up 60, 70, 80% of the vote.
Absolutely.
And all the other votes are
small.
inconsequential.
So
we've been seeing it for ages now. Sorry.
Our effort is to understand whether the ecosystem, whether the employees, whether the suppliers, vendors, and all, do they trust the company they are dealing with? And I think that's very, very important, because over a period of time, I think I am of the firm view that Rome was built in decades, but Hiroshima was destroyed in few hours. So if you don't have a trust, and if you're going through a bad patch, the entire ecosystem will pull their support around you, right? That's very one. The second important point is, delegation. What we are seeing today, and that's my biggest worry of managements, is that the Lala culture is still there. The guys don't want to delegate. They are control freak. And companies who have delegated over periods of time have shown that they can create value. They can get the professionals come in. They can run the show. And the biggest worry corporate India will go through over the next few years is the first or the second generation is retiring. They are getting old, passing it on the mantle to the next generation, whether they are passionate or not, we will come to know later. But they have not professionalized the company. It's still a single key man driven company. And I think that's a very, very important thing to evaluate. The third thing is the scalability. I think IT sector has shown that if you think global, you can scale your business very, very substantially. Many businesses in India struggle on the scale. They don't think global. It's changing now, but that's been the past over the last 17, 18 years. That's scalability, which we evaluate on. The fourth is the integrity and passion. And I think integrity is something which is extremely important for us. And we try to gather a lot of insights from the people, employees, and others on what they're talking. Last but not the least, we evaluate using a lot of social media tools. Let me give you an example. So we were invested in a very large chemical company. We made lots of money, but we heard that there was large attrition taking place in that company. And we asked the management, why is the attrition happening? They ignored. They said nothing. Your information is wrong. We went to LinkedIn and we just typed in X, that company name, and about 12 or 14 of the names came. The people who have left in last 7, 8 months, right? We connected with 6 of them and we came to know what was the reason. We connected with the management again, and they said, these are the 12 people who have left, quite senior to middle level guys. You said nobody has left. And he was shocked whether I touched base with the HR guys on how did I find it. And I said, it's very easy. So that gave us a sense whether they really were trustworthy or not. And also a sense on that you could use technology to do a far more detailing on management evaluation nowadays. So I think in India, we have learned that, at least my experience suggests that management evaluation is extremely, extremely important. A bat in the hands of Virat Kohli will be very different in your hand or my hand. So it's very, very important.
My hand is a duck
is handling that. So,
Mr. Kohli, Mr. Virat Kohli, they get one duck in his lifetime. I'll get all ducks.
All ducks. So I think management evaluation is extremely important across the board. And if you can get the right set of promoters, right set of management teams, I think a large part of your, investing success is given, in my view.
And that's what helps you, and that art and science all put together helps you develop a vibe about
Absolutely.
how
And
these
and
things
and,
function.
and always, I believe that the 1 or 2 hour of management meeting which we have give a lot of insights. People go unprepared, but within our team, we make sure that before we meet the senior management, we are absolutely prepared with our questions. We are absolutely clear of what we want to focus on. And I think the response of those things during that 2 hour, kind of interaction gives us a lot of insights on what they are thinking about.
So this is a sensitive question. No names if you're not comfortable
Yes.
with it. Which was the craziest management meeting you attended where you said, "Oh my God, what the hell are we doing here?"
Many, actually many,
Many.
many. In certain management meetings, management is highly arrogant. To first bring them down to the earth is itself a very thing. There's a disconnect on what you are thinking, what they are thinking. And one of the auto ancillary guys, I still remember, long time back, he started off with a very different thought process only, and we couldn't connect for almost an hour or so. And then we were about to leave, and then he said something which really became a common point between us. And from there, we engaged for another 3 hours. So the 1 hour meeting became 4 hour meeting. But many times it happens that it takes time to connect uh, from a common perspective and a common ground and take it forward. And I have the habit of writing notes. And I have notes going back to 2003, 4, 5 of my management meetings. So when you meet the same management in 2022 and you take them back what you have, some managements don't like it. Some managements say, "Wow, this is what we said and this is what we executed. So there was a large gap or there was no gap, whatever." But it's good that if you document your meetings and interactions, it gives a great flavor when we look back that what they promised and what they executed. And that, I think, gives you a lot of insights on whether they are over promising or under promising.
That's right. Famous Narayan Murthy line. We
Yes.
like to under promise and over deliver.
Over deliver. Absolutely.
Okay. Uh, okay, let's step back from that a bit and talk about you. Which was the first investment you made and what came of it?
So it was, investment made in a cement company. Uh, and
This is through a fund or you pick the stock? Yeah, for yourself.
No, not myself,
Okay.
for the fund.
Okay.
And always I have believed that I have only one focus, which is my fund. The day I don't manage, then I'll manage my money through stocks. But normally I don't invest directly through stocks. It's through the fund, because I firmly believe that if your focus get diluted and you have two books running, you won't do justice to either of them. So have your money invested in your funds and focus on your fund. I think that's the right way to do it. And when we picked up that stock on the cement company, trust me, cement was going through a massive pain in 2002, 3, 4 period. That company's management was not that well regarded because it was a small company. But we could see that they only focused on cement and they wanted to grow bigger with their internal cash flows. And they had never diluted even in this pain period. We trusted them. And today they are India's third largest cement group in the country. And they have done a phenomenal job of wealth creation. I think the stock has multiplied 2,800 times, if I'm not wrong, over the last time since they did their IPO. One of the largest groups in the country. But that was my first pick in 2003, and we compounded hugely out of it because it was an undiscovered stock. Nobody had any belief, and the market cap was just few hundred crores out there.
Yeah, this is my mid cap theme, undiscovered stocks.
Yes.
We'll come to that. Which you've spoken about real estate, infrastructure picks, but which was your first big investment which went wrong?
So many actually, and it was again, as I said, an infra company only.
Okay, so
It was an infra company in 2007.
to be fair, you started at the time when you had to go wrong with infrastructure, right?
So,
It was the hottest thing.
and in market, you have to pay your tuition fee. I
Yeah.
always believe that. But the mistakes were not large enough to derail the returns for a longer period of time. And that's where I say portfolio construction is extremely, extremely important. People get carried away by their conviction. And whenever those calls and convictions goes wrong, the portfolio gets derailed by a couple of years or 3 years. I think that's something which you learn over a period of time from your mistakes, and portfolio construction is important. But I made my share of mistakes in 2007-8. And more than that, Rahul, I think over a period of time, when I reflect back, and as I'm talking to you, the large mistakes were done on error of omission, or error of early selling. And I believe that that pain still remains in my heart every day. And I keep on analyzing that. And, we were the first to identify one of the largest NBFCs, which is in the country today, which has been the last decade's, darling company. And we identified very early. We multiplied maybe 5x, 6x. We couldn't see the opportunity that they will continue to grow very significantly over the next 6, 7 years. And as a result, we just got swayed with the valuation, saying that valuation headline looks expensive. But that's the big learning, that growth is the horse, valuation is the cart. Till the growth keeps on surprising, don't worry about valuation can sustain at elevated levels. So growth is the horse, valuation is the cart, not the other way around.
Okay, so this brings me to the other theme which has been ongoing in the investor hour. 20 years ago, if you spoke to someone, they swore by the Buffett rule. If exit, if you buy cheap, you sell when it's expensive, right? And then Buffett, of course, the smartest guy in the world, right? He, of course, has evolved his process and he's bought all kinds of stocks for various reasons. But one thing what we've been finding in the investor hour, a lot of the people we talk to, they are not afraid of paying a premium for a well-managed company which has a growth trajectory. So the idea, so typically, let's say if I was a true blue value investor, I would say, I can't buy, I'll take a US name to avoid issues. I can't buy Google. It's very expensive, 20 times earnings or whatever it is these days. I'd rather buy a 12 PE stock. But these guys say, no, wait a minute. This 20, you'll probably, it's 20 for a very good reason. There's visibility and the management is clean. You're not going to have any blow up. Suddenly you'll find riding a tiger kind of a email coming to you in the morning. And they say you buy it. And a lot of the value investors have actually gone ahead and done that. So you just alluded to the same thing. You're saying if the growth is the horse and value is the cart, if the growth justifies, you should be okay with the valuation. Don't worry too much about the valuation.
Absolutely.
And this is still in the overarching framework of a trustworthy management.
Absolutely.
Right?
Absolutely.
Otherwise, you end up with an infrastructure stock.
Absolutely.
You want to be sure in a thing. So, did this understanding change? You're effectively telling us it has changed over time. But do you feel this is a general change that you're seeing across the money managers that you admire, you look up to? They've all changed the system, the way they look at stocks now?
Not really. I would say that still that valuation consciousness is there. And there are sets of investors which are buying at any price. At least I am not of that camp, because finally valuation matters. And history always reminds us that, there are many stocks which you still look at. One of the largest IT companies in the country, right? In 1998 to 2000, the stock went up by 100x in 2 years. 24 months, the stock went up by 100x. The owner of that company became the top 5 richest Indians globally. And for 18 years from there, the stock didn't reach the price which it went to 2000, right? So not buying at any price will always make you money. But yes, if it's a quality business, the capital erosion may not be there as a permanent capital erosion, but time-wise, you may have a very large time correction, which you should be prepared. Similarly, we saw in FMCG, the largest FMCG company of our country. for a decade, it gave you just
Hindustan Lever, yeah.
almost 0% return, right?
Yeah.
So you bought at a wrong price and then you saw a time correction for a very long period. So I think valuations are important when you evaluate. And the way I look at it is I look at more than that, the peg. The peg is for per unit of growth. How much is the price you are willing to pay? And many a times I have seen that peg always works and comes very handy in evaluating growth along with price. So if I'm seeing a company which is growing at 30 to 35 times, will I be okay giving 25, 30 times to that multiple? Answer is yes. But if that 35 times growth actually comes down to 15 times, you will see a derating in the valuations for sure. That's why I say growth is the horse, valuation is the cart. And maximum mistakes I have made is the error of omission, where either I have sold early or completely, kind of not looked into that stock even after evaluating. And I missed the big multiplication and compounding, which actually happened.
Yeah. So this PEG, I have a question on that. In 99, 2000, when Equitymaster was getting off the ground in terms of deep research, PEG became a fad. And because people were finding ways to justify the valuation. But there, maybe it all circles back to your famous cash flow, but there was no cash flow.
Cash flow.
You got the you answered it at the start because they got the PEG right.
But the cash flow was not there.
So you could use the PEG in a disciplined way as long as the other stuff filters in.
Absolutely.
That's pretty smart actually. You could actually do that and not be not be taken to the cleaners like they were in the 99 2000 rally.
Absolutely. So basic framework should be there of cash flows, management, growth, profitability. I think valuation is also an evaluation tool which comes after all these things. And also we have not touched a very important point on business compounding. I think, over a period of time, growth is good, but what, Rahul, we have realized that growth at any cost is not good. And time and again, we have seen that companies where return on capital, return on investments is lower than your cost of equity, and they try to grow, they finally destruct value. Okay. The first thing those management needs to do is improve your return on capital. Sell off those, assets which are not productive or generating any return. Make sure that first you move your 7-8% return on capital to 14-15%, and then try to grow. Most of the companies in lure of growth try to grow faster. As a result, the bridge between the growth and your internal generation is there, the gap, and you try to bridge it with your debt or equity. And that you keep on diluting, the balance sheet becomes heavy, and as a result, you create your own grave. And I think growth at any cost is not good. Look at return on capital, look at return on equity, and don't try to grow over and above that. Because if you try to grow, you will be in trouble. And then there are certain other companies which don't understand that if you are operating at 30-35% return on capital or higher than that, what is not important is that you improvise your return on capital further. So if you are a company, you are at 30% ROC, don't try and improvise it to 35%. Try and make sure you generate more growth at that 30%. And then the value which will you create for the shareholders and yourself will be far, far higher than moving from 30 to 35%, but lowering the growth. So these are the two basic, very powerful concepts that if you understand that in the business, I think you will make less and less mistakes. And I always believe in investing, Rahul, that what not to do is very, very important. And then your list of what to do becomes very small and you will be focused. And there comes my Bible and the book, which I think I would suggest all your viewers to listen to or read to, is All I Want to Know Where I'm Going to Die, so I Will Never Go There.
The Peter Beverin book.
It's a Beverin book, a Peter Beverin book. And it clearly shows that what are the mistakes you will not do. And when you focus on that, what the list which remains with you is extremely small. And then you make less and less mistake, and the power of compounding then just works in your favor. Yeah. So you are not there to make money in every bull market, but our job is to preserve capital in every bear market. I think if you are clear in that philosophy, you probably will ignore momentum when it is completely out of whack. And you will bring sanity to your portfolio and make less and less mistakes.
Wow. Okay, this is very, very thought provoking, and I'm going to do injustice, so I don't want to try, but uh, growth is the horse, valuation is the cart, and the environment around it that you have to be careful of is in valuation you're looking at PEG, but overall you're looking at the management thing, the whole vibes thing, the multiple things you want to take about the management. You want to be sure the return on invested capital, return on equity is good. You want to be sure that the management is actually looking for growth. It's like the point about for companies with a high return on capital, it's not important to increase it further, but it's to find more growth opportunities at that high return on
Absolutely,
capital.
absolutely,
Yeah.
absolutely.
And I think if you do that, you start to form a framework which will automatically, whittle down your list of stocks to track by 95%, I guess. And a cash flow. Sorry, I missed cash flows.
Cash flow.
That's the most important thing. Cash
And
flow.
always invert it. So if somebody asked me, what are the things you will do? I said, invert the question and ask yourself, what are the things you won't do?
Yeah.
And then your life becomes very simple. Then your investment thesis becomes very simple. And also keep on telling managements who are at lower return on capital that don't chase growth. The moment you chase growth at lower capital, you will vanish over a period of time. Improve your return on capital and then chase growth.
Yeah.
And I think that's something which is very, very important, that growth at any cost is not acceptable.
Yeah. And inversion is a great way to learn.
Learn. Absolutely.
It just solves so many issues.
Absolutely.
In because you think differently, and
Absolutely.
yes, it helps with that. Okay. Moving on. I typically ask, my guests on where they were on important days. Now, you missed Harshad Mehta, you missed TMT, you've spoken about 2007.
TMT, I was there. I was in college, investing from there. But but not active in the market as a fiduciary responsibility.
Yeah. But how was that? How was that for you? How did it pan out?
Lost a lot of money.
Lost a lot of money. Those tuition fees, just added to your tuition fee bill.
Tuition fee.
Tell me about the Lehman bankruptcy. Where were you that time, and how did you take the news, and what do you think?
So I think so when the Lehman crisis started, I took my holiday, and it was, I still remember, October, and me and my wife decided to go to London, and then the news started, kind of breaking down, and we said that let's prepone our trip and go, but my boss was saying that you stay there. But I think before that, 6 months, we had started getting worried. And we had cut a lot of our cyclical positions before that only, because the sense we were getting is that things are not going in the right way. Valuations were a concern. Quality of companies which were going up was making us nervous. Cash flow, one thing which was not even talked about at that point of time. Only fancy valuation metrics were being talked about. And that made us nervous. And we had already started reducing our significant positions in some of the names which we weren't comfortable. On the hindsight, it looks to be a great one. But when the news broke out, I was on a holiday, and every day at 4:30, I used to wake up, make sure that I'm managing the portfolio redemptions, everything out there, making sure that during the day I'm having calls with my team, and we are all on the same page. But at some point of time, I realized that this thing has extended too far, and stocks were available on sale. Somewhere in early part of 2009, we decided that let's, kind of objectively look at things, that how next 3-4 years could span out. And we were getting some of the best bargains. And, you will be surprised, Rahul, in late 2008 and early part of 2009, I launched a fund called Principal Emerging Blue Chip Fund. Okay. And I went into the markets, and people were like, almost, going to tear you apart, okay? Because the emotions were involved, 60-70% your portfolio losses. And we were the first guys to step out in the market. And I traveled all over the country for the fund launch. And we collected about 14 crores only, or 12 or 14 crores. I said, that's fine, because you are collecting at the bottom of the markets. Normally, we are always blamed to collect at the top of the markets. So we collected that money. And when I quit the firm, I think the fund was 350 or 400 crores. And that was the largest, kind of at that point of time, the highest return generating fund in a year. Never happened in the past. So I think, learn that, you need to have a sense of markets at that point of time that, okay, things are bad, but should you get carried away by the fear? But I saw the opportunity in many companies, many things, and many of the stocks became 20x, 10x, 15x from the low points. And it gave me a sense that the worst time is the best times to invest. And that was the point where you standed out from the rest of the crowd. Your fund gave phenomenal returns. The investors made money, and a small launch, and the other funds which also did extremely well at that point of time.
If you have conviction, you have a process, you can go with it. And I think that's what you did, and that's wonderful. Pandemic, March, right? Whatever,
20.
March
March
2020,
20.
whichever the date was. I don't know what the
Yes.
date was. 22nd or
22nd of March 2020.
20. And markets have started falling a week before that and a week after that.
Early part of March, markets have started correcting. Yeah.
So how was that for you?
So it was a sudden one, but again, indications have started coming that things in China are not looking great. And I think people took it very lightly in January, February when the news started coming out.
So did you have a sense in Feb 2020 that something's happening?
I had a sense that something is not right because things are not looking great in China. And China is one economy where you get very little information, but once it comes out, you should not just ignore it. Had some sense, but didn't expect that in 20-25 days time, the things will go so bad. It's the freshest of the memory in front of us. And we all know that within 20 days, market corrected by 30-35%. There was mayhem. And I just sat back and said that this is the time to ask yourself that whether the world is going to shut down, whether anybody will be alive or not. If nobody will be alive, nobody will care for portfolio and have any which ways. So, and if the world is going to come back with some medical, kind of discovery, these are the prices you will never get back again. And Rahul, it's on public record. There's a CNBC interview which I gave in the first week of April. And I said that the next bull market is coming. And we evaluated the 2000, 2003 scenario. We went to 97,
the China SARS virus scenario.
And before that, the tech bubble.
Yeah.
And before actually markets bottomed out, stocks started moving after the tech bubble. And in 98, 2000 gave us a very good indication. 2002-3 period gave a very good indication. And I explained that how we are in the same period. A global event has happened where we don't have any control, but it has set the market for a next bull market because 18 to 20, only few companies actually moved up in the market. The rest of the market had a bad time. And that was the reset in the markets again. Similarly, 2002, 2002, the rest of the markets were in a bad shape, but some stocks had started moving up already. And I think for the first time, my portfolio went 99 point something invested in the end of March. And that was the full toss we got. And I did the DCF of every company of my portfolio. And on the DCF, even if 1 year there was zero earnings, the DCF impact was 10 to 15% on valuations. But here was, a scenario where stocks had corrected by 50, 60, 70%. And we said that this is the best time to go and own your stocks and show your conviction. And I think rest is history. That last 2.5 years has been extremely kind to us. And God has been extremely kind.
I was erroneously going to say there was a Hail Mary pass. You said, I have nothing to lose, let me go. Let me go for it. But you actually had done your numbers.
Absolutely.
And it showed you that logically, if the world survived, you're getting things
extremely cheap
on the dollar.
Yeah, absolutely. But that time, I have believed that business management, cash flow, balance sheet, valuation is all good. Okay. But the biggest road to success in investing is managing yourself. There are ample things which you can't do anything, but if you can manage your emotion and temperament, and that each of us have to reflect back in the past and see how did we behave ourselves And when I'm talking to you, and every instance is coming live in my mind right now, that hindsight, everything looks easy. But when you're in that storm, when things are hitting you, trust me, it's not easy.
Right.
And that time, how you behave and how you overall conduct yourself is the most important part. So managing yourself is very important. So I always say KYS is more important than KYC. Knowing yourself is more important than anything else.
That's a nice one. That's a nice one. But the point you mentioned is very interesting in the context of the bear market, because when you said you have to lose less money in the bear market, you have to survive the bear markets well, and then the money will automatically get made. And I think typically people make the worst decisions at the bottom of the bear market.
Absolutely.
In the bull market, what happens is, for some reason, I feel the more damage is done there, because people just lose hope and they sell whatever they have, right?
Absolutely.
And usually when the market turns, it's the VIPs, the better stocks that rally the most, right?
Absolutely.
And at the fag end, you may get all the penny stocks and all to move.
Absolutely.
But you're so right. And if you think back all those moments, and I encourage all the viewers to think back and try hard. Memory plays tricks with your mind. They'll make you seem like you were the hero, you did the right thing. But
absolutely,
think hard on how the situation played out. And I think if you can improvise, keep a journal, and maybe
keep journaling it.
Yeah.
Keep journaling it. I think that's the best way to reflect back on your investment decisions.
Yeah.
And how you behaved at every point of time. I think it's very, very important.
Okay. So let's talk portfolio construction. Now, you are talking portfolio construction from a fund's perspective, but our viewers are individuals. How do you see it being different for the two? Because I think for an individual to manage, I know how many stocks you have, probably 30, 40 stocks in your fund. That's a lot for an individual to, kind of keep track of.
See, Rahul, I've always believed the end outcome which matters to all of us, whether it be fund or individual, is to compound your wealth. Okay.
Mhm.
And if the end result is the common one, the approaches to that can be different. For example, to me, always a little bit of diversification has helped us, because I am a guy who always questions myself that my decision may go wrong. And if my decision goes wrong, am I putting a lot of capital at risk, which has a probability of permanent loss of capital? That's my worry always at the top of my head, because I believe that hard-earned money, people's saving has been given to me, and my objective is to, over a period of time, compound it. I think the same objective lies with any individual investors as well. Normally, what people make mistakes are two. One is, sizing. I think they don't understand sizing and the kind of risk they are taking. And during bull markets, they take oversized bets, which they cannot digest. And a 20%, 25% fall kind of, make them nervous. So understand your temperament, understand your risk-taking ability, and size your bets accordingly is the first thing one needs to understand. How much you can digest if this call goes wrong. And the second thing is that normally you would hear people that, I have got this winner, I have got this winner. But nobody will talk about the losers which are sitting in the portfolio. And the biggest is that they let their, they book their profits in the winners and let the losers continue. And opposite actually should be the true. You should cut your losers fast and let your winners run the course. But very seldom it happens. So I think what helped me, and there are debates about concentration, diversification, but I am of the camp that a little bit of diversification takes out the risk across us from different sides of global, local, and other sides. And over a period of time, if you can survive on the pitch for long, then only you can play the match. Yeah. To finish first, you need to finish the game, right? So absolutely, there's a very important saying. So if you want to compound your wealth, you need to make sure that at every cycle of the market, you have a stay. You are being put on the market. But if you lose all your capital in one bear market, trust me, the next bull market, you will not be able to participate. And we see lots of people around us who are doing that. Hence, I think portfolio construction becomes extremely, extremely important. Yeah. And there, I think the diversification, looking at sectoral and stock weightages, looking at, other things in terms of, are you putting all the eggs in one basket in a sector? Are you diversifying across various things? If your cyclicality call doesn't go well, is there to something to cushion you in a bear market? I think basic of those portfolio construction, if individual also does it, I think that person will be successful.
Yeah, and I like the point you made about typically you should let your winners run and and possibly get rid of some of your losers,
Yes.
and that in itself over time will create a very good portfolio for you if you're disciplined.
Absolutely.
And I think all you have to do is get over that, like they say, right? The fear, the pain of loss is much bigger
Absolutely.
than the fun and the
Fun
excitement
of winning.
game.
Yeah.
So if you can simply train yourself to get rid of the losers, I am guilty. I know we all easier said than done.
It's
But
said
if you
and
have
done.
done that,
But I think that's something which most individual investors falter on. They cut their winners very, very fast and let their losers run the course, because the emotion part is attached. That how can I go wrong? How can this company go wrong?
Yeah.
And I think that's something which, if you take emotions out of stock investing and look at objectively, probably will not make that mistake.
And then the media does not help, because all the algos feed you what you want to read.
Absolutely.
And you suddenly start, oh my God, this company's in the news again. And
Absolutely.
something is going to happen. And
Absolutely.
the rest is history. At
Absolutely.
least, but I must clarify, I'm not guilty of the second thing, selling too soon. I'm only guilty of the first one. Okay. I want to talk to you a little bit about mid caps.
Yes.
How is it different from the typical, a normal conversation is what? Hey, Tata Motors is doing this, Unilever's done this, Starbucks is doing this, Google's doing this. No one's talking of that unknown company sitting in a suburb of Bangalore, Bombay, is a relatively smaller size, may not have a national brand. How does it feel like to be operating in that space? And how do you approach it? How different is it?
So, for your viewers, let's get the definition right first. So, as per the original definition by the regulators, the top 100 companies of India are defined as large cap. 101 to 250th market cap company is defined as mid cap, and anything up below 250th is small cap. So virtually, if you remove the top 100 companies of India, the rest of the market is your universe, right? But I think the way it is that the word multi-bagger has been not understood properly. Everybody wants to get that next multi-bagger. Everybody wants to get the next big thing. But look at the statistics. It's amazing. In the last 20 years in India, only 5% of these small caps have moved to become large caps. Okay.
Mm-hmm.
And only 9% of mid caps have moved to become large caps. And that means the probability of a elongated compounding and that P re-rating and that capital appreciation or 100 bagger is very, very low. So that statistics shows that you can go right for a short period of time, but if you want 100 bagger, there are various things involved in that. And in my view, in this space is full of time bombs and landmines. You need to navigate it very, very carefully. And that's where it comes, that process of elimination helps you a great deal in it. There are 5,000 listed companies in India, and our focus is only on 430 companies. The rest 4,600 companies are not a part of our universe to even track. That means by process, 90%
already cleaned out.
out. So you need to make sure that you have a framework where you know that these are the things which I will not invest in, or these are the parameters I will look into and take a decision on investing. Once you do that process of elimination, your universe which is left is very, very small. And then you do a detailed research and scuttlebutt in it. And I believe that there's a lot of research arbitrage if you can pick up companies right at the start. Even if you miss, 2x or 3x, don't worry about it. Because in the journey of 50x, 100x, even if you miss the early part, it doesn't matter. Let the company, grow a little bit in size and then and kind of look into. And my sense is that there are huge opportunities which we have captured in the portfolio over the last 1.5, 2 decades, which have kind of become large caps, mega caps as well. And the learning has been that companies goes through cycles as well. There's no company in the growth phase perpetually. You need to be patient over the longer periods of time. Let me give you a small example. Amazon got IPO'd in 97, right? From 97 to 2001, the market cap got eroded by 95% because it was a tech bubble and people just kind of shattered it. From there to reinvent itself and come back stronger and stronger, you saw what Amazon is today, among the top 5 valued companies in the world. And people who even jumped on the bandwagon, even after 3, 4, 5 years, also make multiplicative returns. So the point is that don't worry about, even if you have missed the first, 2x, 3x in your journey, but focus on a longer periods of time. And one thing which I have observed, that great companies become stronger after every crisis. And this is something which is very important, that if it's a good quality company, trust me, if any crisis happen, the next few years of that company will be amazing, because they must have learned a lot of things. They may have tightened some of the nuts and bolts, and they move out and become emerging very, very strong. And they move to the and pivot to the next level itself.
They
And
get
these are the
market
classic
share
things.
from weaker competitors.
Weaker competitors, they have managed their balance sheet cash flow well. They have strengthened the investment team. They have tightened the processes, looked at the working capital, asset turns, and so on and so forth. And I think in this pandemic also, it's been proved that many of the companies who survived the crisis have become stronger and larger after the crisis. So my firm belief is that over a period of time, these things are tested. And in the portfolio construction, have a gorilla to King Kong strategy. Have 30, 40 gorillas in your selection of process. Trust me, nobody knows which is the multi-bagger they're making today. On the hindsight, we all are wise to say that, oh, I knew this was a 10x, 20x, 30x. Trust me, when you buy it, you believe it's a good company, but what multiplication it will do, you never know, right? So point is that have a gorilla to King Kong, have 40, 50 gorillas in your portfolio. Few of them will turn into King Kong based on the execution over a period of time.
And get rid of the losers over time.
Losers over a time, which are
process.
not there. Absolutely. And in mid cap space, it's extremely important that you keep on evaluating managements, keep on looking at things. And the way I have approached about building my portfolios is I don't go first day all in. I build small positions. I watch them very closely. I watch them on conference calls. I watch them in meetings, and then build my conviction over a period of time. At one go, I just don't buy 5% of the portfolio or 10%. Even I may be fully convinced, but I question myself, if I go wrong, what? So build it slowly and slowly and slowly.
Because what you're saying is in mid caps, the risk is not missing out the initial gain. The risk is you'll get into a time bomb or a landmine. So it's better, it's fine to lose the initial little bit, but don't lose what really follows.
Because if you are a journey of 50x, 100x, it doesn't matter. Because you should be focused that this small is becoming large and mega cap. If that's the journey, then over a period of time, even if you make the early part of gains, it's fine.
Yeah. Since we are talking mid caps, I'll give a disclosure. I for the viewers, I'm kind of invested in Pankaj's fund.
Oh, okay.
And I take the same approach with even my mutual fund investments. I put a little, track it, put more and all, and it's been fascinating. I'm like wondering how these guys are able to pull this off in such a volatile time.
Absolutely.
So
it's not easy.
To you and your team, super.
Thank you, Rahul, for your kind words.
Okay, now asset allocation. Now I'm talking Pankaj. I'm not talking the fund. How do you think about asset allocation for the Tibrewal family, right? You're the boss, you're deciding. So there is equity via funds or whatever, there is debt, there is real estate, gold. How do you approach it, and How
So
does
my asset allocation is very different from my brothers or fathers. They are little conservative.
okay.
So
Conservatives, SBI FD, SBI FD
so
kind of people?
more of debt and rental income and debt and all that, less of equities.
Mhm.
And mine 90% plus equities.
Awesome.
So
Yeah.
I believe that this is the only liquid asset class which can help you in compounding over longer periods of time. I
Mhm.
have tasted compoundings over the last 2 decades. I understand how it works. And a large part of my asset, which is 90% plus, is in equities.
Okay. And then you own your residence. You have one residence
Absolutely, absolutely.
and no other real estate, no gold, not much, nothing.
Nothing, nothing, nothing.
Yeah. You're not
I
buying
mean,
jewelry for your wife, Pankaj?
no, well, jewelry is something which, if she wants, she can, but never invested in jewelry just for
Never
the
not
investment purpose. Yeah, absolutely.
That's fair.
Uh,
For
and,
you,
and,
for you,
and,
sister.
and I believe that, I walk the talk. I believe if I preach people that compounding is the eighth wonder, if I don't practice, because seldom I see many of the people, they talk equities, they manage funds, but on the personal side, they're extremely conservative with their financing.
I've noticed that myself. Yeah. Okay.
Yeah. So I think my approach is that this could be the golden era for the country, which I have been maintaining for a long period of time. And if we don't do justice to equity investing properly, our kids won't be kind to us. That Papa आपने क्या किया wealthy generate नहीं किया. So so
But the big lesson which I'm sure I know you know is that you shouldn't tell them that you generated wealth.
yeah.
Yeah. They should find out much later in life.
Much later in life. Yeah, but I think
No.
equity investing is something I believe in. I believe in the compounding part. I believe in the long runway of growth of many sectors companies are having in the country today. And I firmly believe that we are going through some transformational changes in the country at the ground level. And if those work around, the texture of the country in the next decade or so will be very, very different.
So, we're talking India, but I've got two more personal questions to
Yes.
go through. We'll get through that and come to India again. How do you plan living expenses? Like you keep a reserve, how many months, how many years?
So normally, just on the conservative side, 2 years of my income, generally kept it, kind of side, so that if any casualty happens in life, that's taken care of without getting, dipping into the investment part.
Okay. The other one, which I ask everyone, and I get the best answers from everyone, is your wife comes to you and says, Pankaj, last couple of years, we didn't go out much. We didn't spend a lot of money. So I've accumulated 1 crore rupees. Now, what do you want me to do with it? So give me advice. So what would you advise her to do with the 1 crore rupees?
So, you know what? 23rd March 2020, and my wife has a very strong gut about markets. Okay.
Okay.
I was hassled, puzzled at 1 o'clock in the morning, okay, at night, I mean, whatever you can say. And she comes and says that, why are you so worried? I think the markets have bottomed out. I said, what are you saying? The world is dying and you're saying markets have bottomed out. So she said, no, I have a very strong gut. And she said in 2008-9 as well, when we were on holiday, that this time you will not get back again. And she said that, I think I have a very strong feel that markets have bottomed out. This money is lying in my savings account for a very long period of time. Why don't you tomorrow morning just invest everything in your fund? I am saying that boss,
Pankaj is
there's
still
a
doing his numbers and all that.
and I say that boss, there's a probability that markets may correct another 20-25%. She says that's fine, I'm okay. But make sure that the money is invested tomorrow of my savings into the funds. And she was so right. And when I reflect back on our portfolio, it's more than doubled in 2.5 years time. And she always knows that holiday and all expenses is she gets whatever she wants. So whenever she has surplus, she comes to me and says that what to do and where should we invest in. So my only answer is equities.
Equity,
So she says that
Given,
should we diversify risk?
yeah, given her track record, I'm wondering whether I should have interviewed her.
Next time.
Okay. Now, one serious question before we wrap things up. We are talking India, right? Early 90s, there was this big story on India, right? It did not end well. We know that it didn't end well. Again, we've gone through, I think, probably 2-3 cycles. Then there was that whole BRICS thing. we've been through multiple cycles where it was like, now this is India's time. And anyone who went in with that view that this is India's time and played a top down story probably lost his shirt or came away disappointed, right?
Absolutely.
Ultimately, the stock market has shown over the last 25 years, the winners are bottom, it's a bottom up story that has worked.
Absolutely.
Now, when I'm talking to people like yourselves, I can clearly sense a much stronger conviction in the India story than what I would have sensed even 5 years ago. So, talk to me about that. Has something changed in your view? What has changed? And why do you believe that this time it may be for real?
Yeah. So there are major transformation changes, Rahul, which I feel is happening at the ground level. Let me take you a few of the thoughts which I believe will help you and your viewers understand it more carefully. After a decade or so, for the last decade, we were always running on one engine called consumption, and manufacturing, real estate, which are large animals for growth, were not performing well. What I am picking up from the ground that the kind of positivity and bullishness I have seen among entrepreneurs, I'm seeing among companies associated with manufacturing, I have not seen for a very, very long period of time. And my sense is that we are at the cusp or inflection point of a completely new investment cycle, which will last for a very long period of time. And that will provide the next engine of growth to the country. Because consumption only runs to a certain extent. If you're not supported with uh, employment, if you're not supported with manufacturing, it just falters. And what are the reasons for it? If you look at, there are three, four, transformational changes which has happened. The first one is the government side. They have been doing the heavy lifting for 5, 6 years, and they have multiplied their expenditure both at the center and the state level. So they have supported the economy. The second thing which is starting to play out at the private sector, after the PLI scheme, things happening at various sectors are just crazy. Let me take you to electronics. If you ever get a chance, visit a place called Sri City in Andhra, 10,000-acre cluster of land, and the kind of mobile manufacturing unit we are seeing set up. Foxconn, Pegitron, Wistron, which are the three manufacturers for Apple. All three are there, won the PLI license. And now the entire ecosystem around that is kind of developing out. And in my view, in next 4 years, we would be producing and exporting 75 crore handsets from India, which virtually was not existent. Similarly, I don't know whether you know a place called Morbi in Gujarat. That's a place which has become the second largest industrial cluster of tile manufacturing in the world, and their logo is cheaper than China, better than Italy. And there are 750 units which are all run by Guju promoters there. There's no large Infosys, TCS, or Sun Pharmas of the world. And 3 years back, their export revenue was 5,000 crores. My sense is this year they will end at 18,000 crores. And they are taking away market share from Spain, Italy, and everywhere. And this China plus, and in my view, the bigger one would be the Europe plus. What Europe is going through, the energy crisis, is just crazy. Day after day, plants are getting closed. There's no gas supplies. And I think the large part of manufacturing of Germany and Italy, I feel, will be outsourced to India. Because if they don't want to go to China, there's no other country in the world except Mexico to a certain extent, which has the skilled manpower. And trust me, unskilled manpower, we saw it moving to Bangladesh, Vietnam, Thailand. But you can't produce engineers overnight. And India produces 1 million engineers overnight. We saw it in IT, we saw it in pharma. And I think after a long time, the sense I'm getting at the ground level, that the same vibrancy is there at the inflection point in manufacturing. And if we don't make a self goal, if we don't make any policy mistake, I think we all will be surprised at the renaissance of manufacturing after a very long time. That's one thing which is making me bullish. The second thing, Rahul, is the entire IT stack, which the country has developed. And trust me, the payment system is best to none. And that's actually leading to a lot of formalization of the economy. We all are surprised that 60, 70,000 was the GST collection every month. Now, considerably, it's moved to 1,40,000, 1,50,000. How did you do that? By entire having an IT architecture and making sure that all loopholes are closed down. The same thing is happening, and I give this example that 100 crore bank, 100 crore Aadhaar, and 100 crore mobile connection is the deadliest cocktail India has ever got. If 2 years back, I would say that India will vaccinate 140 crore people in 9 months on an Aadhaar card, and the syringe goes inside your skin, and the certificate is 2 minutes there on your mobile, you would have laughed on me. The fact of the matter is, it has actually gone through, and we are seeing it with our own eyes. Now, consider that over the next few years, any policy reform the government wants to do, it can do in few days, weeks, at the village, at the taluka level, and wherever they want to reach. This IT stack will make sure that the personal income tax collection over the next 3-5 years will surprise us. And that's the major mega trend which we are undergoing through. Any government comes in, goes out, nobody can reverse this change now, right?
Yeah.
The third is the residential real estate part. After many years, we are seeing the revival happening. And
I have hope for my Pune apartment.
It will sell off very soon. Don't worry about it. So I think that real estate revival is real, right? And still, it's an end user demand. There's no investor interest. There's no speculating interest. And I believe when real estate wakes up in India, 200 industries around with it, steel, cement, pipes, tiles, plywood, mattress, consumer durable, everything goes up. And my sense is this will contribute 1% of the GDP incrementally going ahead. And another is the entire outsourcing part. In this COVID, we increased our 0.7% share in the world outsourcing, pie. And that's a large one because work from home is now accepted reality. And it's not that you're working from New York, San Francisco. It doesn't matter. It's just that the work gets to be done, whether it's out of India or anywhere else. And I think this entire change is making me believe that the growth this time could be far more structural in nature rather than cyclical in nature. The second one is that for your viewers and your information, next year, India will contribute 25% incrementally to global GDP growth. 1/4 of global GDP growth incrementally will come from India, and 30% of incremental Asia GDP growth will come from India. And that's a large engine. And don't forget the top 20 followed investors of the world. Warren Buffett, Bill Ackman, you take anybody of them, none of them are invested in India still now. So think about it, that you become the growth engine for the world, which China was for 20-25 years, and you start incrementally contributing a large part. And the large investments, which have been, legendary investors, are still not invested in India. Yeah. So my sense is, obviously there are risks, there are policy risks, self-code. Let me caveat with that. But I think that we are going through some transformation phase in the country. Always history has taught, as you rightly said, don't be too bullish on India. Don't be too negative on India. Have a balanced approach that will make you money. And I still remember I was in my high school, 91, right? India was $300 billion economy. Today we are a 3 trillion economy. And I did a, kind of a self exercise for me. From 91 till 2022, 31 years, I read down every year one of the major incidents which happened in the country, which made you nervous as an investor. Every year, something happened in the last 31 years, but you compounded or you multiplied 10x on the economy size, and in markets you compounded at a crazy rate, and stocks also, right? So the point is that we generally miss the big picture and get swayed by the intermediate volatility so much, and with our emotion and greed and fear emotion side, that we miss out the larger opportunity which is standing in front of us. And I think China's loss this time would be India's gain. And I believe that the resilience we have shown in the COVID times as a country, it makes me immense proud of the next India we are looking at. Vaccination was ours. The entire IT stack was ours. The approach of not giving freebie decision was ours. We didn't copy the West.
In hindsight, that was such a
smart move. Smart move. Otherwise, we would have been killed by the same inflation which is daunting the Western world.
And the depreciation of the currency, what we are seeing in Argentina, Brazil,
or anywhere else, or Japan, for example. Japan has, depreciated 19% in 1 month. I think when you look back and reflect, there's something changing out there at the ground level. And I think that's something we need to recognize it marry it with bottom-up stock picking, look at good businesses, look at good management. But the bigger picture, even if we have drawdowns, even if we have volatility, which always will be there, I think the bigger picture is very, very reassuring this point of time.
Yeah. So I think I've not had anyone put it so clearly to me about the India story. So thank you for that. I'm
Thank
sure
you.
the viewers get it. We all have a sense of it. We all have elements of it, but the way you put it was, very great and very, very helpful, easy to understand. My last question. I've already eaten up a little bit of your other family time, Saturday.
No, this is
I'm sitting
not
recording.
a problem.
You recommended one book. All I need to know is where I'm going to die, and I won't, whatever the rest of the title is. Any other books or you'd like to recommend? Also, if you
Many
can
books are
recommend,
lying right there. So I think one book which I think as a practitioner I have enjoyed, and the one fund manager who is still managing funds whom I admire a lot is a guy called Terry Smith from fundsmith.com, right?
UK. Yeah.
Fabulous guy, talks a lot of sense, and actually you can relate with him because he's also managing money. You're also managing money, so it gives you a lot of feel. I think
Yeah.
great one to kind of follow.
I can
If
add to that. He every year he does a Q&A, and
absolutely
that is fantastic to listen to.
fantastic, absolutely. And
And,
if you
what I
go
like, what I like about him, he calls a spade a spade.
straight,
Like now, this time he's taken on PayPal. You must have read that. It is,
last year he took on Unilever,
yeah.
and
Last year was
and
yes, yes.
and he wrote about it and
Yeah.
very very voraciously. So I think a lot to understand and learn from that guy.
Yeah.
And he's called the Warren Buffett of Europe. So a great guy to follow for a lot of your viewers who may not know him because he's not that famous in India from that
I
perspective.
should try and get him for the podcast. Actually, I'm just making a note.
Yes, he could be a great one. I think he can add a lot of value to investing side.
Who else? Anything else you want to recommend?
Howard Marks, the cycles,
Cycle.
master the cycles. Yes, I think a great read because markets are all about cycles over a period of time, and you can understand that everything at a price is worth investing and relooking. I think that will always be good.
Do you read international media to broaden your perspective?
Absolutely. So a lot of sectors, I read only international reports and international media because it gives a very different perspective of what the trends are. And many times we feel that the kind of valuations we are giving to these companies in India probably are not justified because eventually those disruptions will hit here as well. It's just a matter of time.
Yeah.
So it gives you a very different perspective, I think. And I'm a vivid leader across the board. I spend a couple of hours every day, whatever said and done, just to read things
Yeah.
across anything under the sun, anything under the sun.
Yeah. You read something like a Wall Street Journal just to get a flavor of.
So read New York Times, Wall Street Journal, FT. Economist is a Bible for every month. You have to go through that Economist. What's
I've been reading it for like 25
Wow.
years now.
Wow. You can't miss it. Once you have got used to, you can't miss it.
Yeah.
So those are the things which you kind of catch up every now and then. And I think I would just request all your viewers, especially the young ones. I'm really surprised when I interview a lot of people, I meet a lot of people, that young guys are not reading a lot. And friends, please, it's the only thing if you can do is just read anything under the sun. It will broaden your perspective and horizon a lot.
Yeah.
And the second thing which I will request all of the young guys, stay humble all periods of time. And one thing which always we have not spoken about managing yourself, which is the most important tool of success in investing, is that humbleness is something which should always be maintained at every points of time, because markets will give you very high at a short period, will drain you out also. And that can be only achieved through meditation or vipassana. And one thing which anybody would like to take away from this podcast or this video is that please spend some time in getting a spiritual anchoring. Trust me, friends, it will help you a lot in getting a very clear mind and a focused mind over a period of time. Get this art learning. If you can discover this and discover yourself, 90% of your investing journey is done. And this will help you during good times and bad times, you will have a view of equanimity that if good thing is happening, it's not because of you, and this will also pass. If bad thing is happening, it's not because of you, and it will pass. So you will maintain that calm and composure over a longer periods of time. And it can only be achieved through everyday meditation, or at least once a year if you can go for Vipassana for 9-10 days. I think that will be great. So these are the some things if you want to. Baki all to kya hai, there's enough literature being written about in life, but I have with my close experience experienced this from a very, very long time, that how meditation can help you evolve as an investor.
Yep.
And that's something which I would urge all of your viewers and your listeners to actually practice.
On that wonderful, wonderful note, Pankaj, thank you very much for taking the time out. It's been a fascinating conversation.
Thanks, Rahul. Thanks. It's been a pleasure, and thank you for inviting me and talking to you. It's been real pleasure.
Thank you. Wonderful.